Provisions, Contingent Liabilities and Contingent Assets. A complete, practical guide by Candymentor. Candymentor.com. Hello, and welcome to Candymentor. Today, we're decoding IND 37, one of the most judgment-heavy standards in accounting. It tells you how to deal with uncertainty, when to record an expense as a provision, when to merely disclose a contingent liability, and when to recognize a contingent asset. By the end, you'll know exactly what to recognize, what to disclose, and what to leave out. Now, objective and overview. The purpose of IND 37 is to set consistent rules for how companies handle uncertain obligations and potential gains. It covers three key items: provisions, contingent liabilities, and contingent assets. These terms all deal with uncertainty, but the timing and certainty of outflows or inflows differ. The main goal is to make sure companies don't overstate assets or understate liabilities. In other words, it promotes realistic financial reporting, no hidden losses, no inflated profits. This standard is based on IAS 37 from the International Financial Reporting Standards (IFRS) framework, adapted slightly for Indian context. 2. Key definitions. Let's start with the core definitions. A provision is a liability of uncertain timing or amount. So, you know there's a responsibility, but you're unsure how much or when exactly you'll pay. A liability itself is a present obligation arising from a past event where you expect an outflow of resources, usually cash or services. A contingent liability is a possible obligation. It might exist or it might not, depending on some future event. Or it could be a present obligation that isn't recognized because the amount cannot be reliably measured. A contingent asset, on the other hand, is a possible asset, a potential inflow that depends on uncertain future events. You recognize it only when the inflow becomes virtually certain, not before. Think of it like this. A provision means we'll probably pay. A contingent liability means we might pay. And a contingent asset means we might receive. End. 3. Core principle IND 37 revolves around one core principle. Recognize a provision only when three strict conditions are met. 1. There is a present obligation, legal or constructive, from a past event. 2. It's probable that an outflow of resources will be required to settle that obligation. 3. A reliable estimate of the amount can be made. If even one of these conditions is missing, you cannot record a provision. At most, you'll make a disclosure. This keeps the balance sheet clean and prevents guesswork-based liabilities. 4. Types of obligations. There are two main kinds of obligations under this standard. First, a legal obligation. This arises from laws, contracts, or court rulings. For example, a warranty mandated by law or damages ordered by a court. Second, a constructive obligation. This is softer, but just as binding in spirit. It arises when a company's past behavior or public commitments create a valid expectation. For instance, if a company always refunds unhappy customers, even though it's not legally required, customers expect that refund. That expectation itself becomes an obligation. Both kinds require recognition if the other criteria are met. 5. Difference between provision and liability. Let's make the distinction crystal clear. A provision is an estimated liability, uncertain in amount or timing. A liability, like a trade payable, is definite. You know exactly how much you owe and when. For example, a warranty claim you might have to pay is a provision, but a supplier bill due next week is a liability. So, a provision is essentially a best estimate liability. 6. Recognition criteria for provisions. To recognize a provision, all these boxes must be ticked. There's a past event. Something already happened that created an obligation. There's a present obligation, legal or constructive. It's probable that an outflow will occur, meaning more than 50% likely. You can make a reliable estimate based on data, history, or reasonable assumptions. If any one of these tests fails, stop right there. No provision. You only disclose the situation if it's significant. Unquote. 7. Measurement of provisions. When you do record a provision, you measure it at the best estimate of the expenditure needed to settle the obligation. This best estimate should reflect risks and uncertainties surrounding the obligation, future events that could affect costs, such as inflation or new technology, and discounting to present value if the time effect is material. So provisions aren't guesswork, they're informed estimates. Example: if you sell 10,000 machines with a warranty, you can use past defect rates and repair costs to calculate a realistic amount. End of parentheses. 8. Expected value versus most likely outcome. There are two approaches to estimating provisions. The expected value method is used for large groups of similar items. For instance, many warranty claims. You use probability-weighted averages of all possible outcomes. The most likely outcome method suits single, specific cases, like a pending lawsuit. Here, you pick the most probable result, not the average. Always choose the method that best represents the real risk pattern. End. 9. Present value and discounting. If an obligation will be settled more than 12 months later, you must discount it to present value. Use a pre-tax discount rate that reflects the time value of money and risks specific to that liability. Over time, as the settlement date approaches, you unwind the discount. The increase in liability due to passage of time is recognized as finance cost or interest expense. This ensures long-term obligations are shown realistically on today's value terms. 10. Review and adjustments. Every provision must be reviewed at each reporting date. If new information comes in, or the likelihood of payment changes, you adjust the amount. If the obligation no longer seems probable, the provision is reversed through profit and loss. This rolling review ensures your provisions reflect the latest facts, not old assumptions. 11. Use of provisions. Provisions must be used only for their intended purpose. For instance, a warranty provision can be used only to cover warranty costs, not to offset losses from other areas. This prevents what's known as income smoothing, using excess provisions to artificially stabilize profits over time. Each provision has one purpose and one purpose only. End. 12. Contingent liabilities. Definition and treatment. A contingent liability is a possible obligation. You're not yet sure whether it exists or how much it might cost. For example, a lawsuit filed against your company. If the outcome is uncertain, it's a contingent liability. Such items are never recognized as liabilities on the balance sheet. Instead, they are disclosed in notes to accounts, unless the likelihood of loss is remote. This keeps readers informed without cluttering the financials with speculative numbers. 13. Contingent assets, definition and treatment. A contingent asset represents a possible inflow of economic benefits, but it depends on uncertain future events. You don't recognize it initially because that would mean recording potential income before it's certain. Only when it becomes virtually certain, meaning almost guaranteed, do you recognize it as an asset. Example: an insurance claim after a fire. Disclose while it's probable. Recognize only when the insurer confirms payment. Over. 14. Onerous contracts. An onerous contract occurs when the unavoidable costs of fulfilling a contract exceed the expected benefits. Here, you must recognize a provision for the lower of the cost to complete the contract or the penalty to exit it. Example: if fulfilling a supply contract will cost 12 lakh, but you'll earn only 10 lakh, record a 2 lakh provision for the expected loss. 15. Restructuring provisions. Restructuring refers to large-scale changes such as layoffs, closures, or relocation. You can record a restructuring provision only when 1. A detailed formal plan exists, and 2. A valid expectation is created among affected parties, usually through an official announcement or start of implementation. The provision covers direct costs such as employee termination, lease cancellations, and site closures, but it excludes future operating losses, marketing spend, or training costs. Those are not obligations yet. 16. Future operating losses should never be recognized as a provision. That's because there's no present obligation. You can't owe money for future losses. However, recurring losses might signal an impairment issue under IND 36, which must be tested separately. 17. Warranty provisions. Example: warranty provisions are a textbook example of IND 37 in action. The obligating event occurs at the time of sale, when the company promises to repair or replace faulty products. You estimate the cost based on past data, say defect rate and repair cost per unit. Example: if 2% of 10,000 units are expected to have defects and each repair costs 1,000 rupees, provision equals 2% times 10,000 times 1,000 rupees equals 2 lakh rupees. This amount is recorded as an expense with a matching provision. End. 18. Decommissioning or restoration obligations. These arise when companies must restore sites or remove equipment after use, like mines, oil rigs, or nuclear plants. You recognize a provision when the obligation is created, typically at installation or operation start. The amount is discounted to present value and added to the cost of the related asset under IND AS 16. Over time, the liability increases due to the passage of time. That increase is treated as a finance cost. The end of the explanation. 19. Example journal entries. Here's how provisions flow through the books. Creation of provision. Doctor expense. For example, warranty expense. Credit provision for warranty reversal when no longer needed. Doctor provision for warranty. Credit expense. Reversal of provision. Settlement of obligation. Doctor provision. Credit bank or payables. Unwinding of discount for long-term provisions. Doctor finance cost. Credit provision. This life cycle captures recognition, adjustment, and settlement clearly. Unquote. Disclosure requirements. Transparency is key. For every class of provision, companies must disclose the opening and closing balances, additions, usage, and reversals, a description of the nature of the obligation, uncertainties involved, and the expected timing of outflows, and details of any reimbursements, such as insurance recoveries. For contingent liabilities, disclose the nature, estimated financial effect, and potential reimbursements. For contingent assets, disclose when inflows are probable, but not yet certain. This level of detail helps users assess risk exposure. 21. Distinguishing between items. Quick decision matrix. Here's a quick recap. If there's a present obligation and probable outflow, record a provision. If there's uncertainty about obligation or amount, only disclose it as a contingent liability. If it's remote, meaning almost impossible, ignore it. If you expect future income that's only probable, disclose as a contingent asset. If inflow becomes virtually certain, record it as an asset. Example: a tax dispute you'll probably lose, provision. A court case with uncertain outcome, disclosure. An unlikely lawsuit, ignore. An insurance claim likely to win, disclose. Court awarded compensation confirmed, recognize. All right. 22. Comparison. IND-AS 37 versus IAS 37. Both standards are almost identical. IND-AS is based directly on IAS 37 from IFRS. The key takeaway: neither allows provisions for general risks or future losses. Both require clear disclosures for transparency. The only real difference: Indian presentation aligns with Schedule 3 of the Companies Act. 23. Common mistakes. Common errors include creating provisions for general reserves, not allowed; forgetting to discount long-term obligations; recognizing contingent assets too early; failing to review provisions annually; and using provisions to smooth profits across years. Auditors specifically look for these red flags. End quote. 24. Audit and valuation focus. Auditors focus heavily on judgment and evidence. They check whether management's assumptions are reasonable and supported. They review contracts, correspondence, and legal opinions to confirm obligations. They test whether provisions are updated and disclosures complete. They also verify that subsequent events haven't changed outcomes. This ensures that provisions reflect the real economic position, not management optimism. 25. Real-world examples. Let's see how this plays out in practice. Automobile manufacturers create warranty provisions for sold vehicles based on past claim data. Oil and gas companies recognize decommissioning provisions for restoring drilling sites. IT companies record restructuring provisions when announcing layoffs. Banks disclose contingent liabilities for guarantees, pending litigations, and letters of credit. Each industry applies IND-AS 37 differently, but the logic is always the same. Record when probable and measurable. Disclose when only possible. End. 26. Closing and summary. To wrap up, IND-AS 37 teaches discipline in dealing with uncertainty. It ensures obligations are recorded honestly, not too early, not too late. Here's the final cheat sheet. Provision when outflow is probable and measurable. Contingent liability. Disclose, don't record. Contingent asset. Disclose only when probable. Recognize only when virtually certain. The ultimate goal: protect financial statements from both hidden risks and false optimism. That's how IND-AS 37 keeps financial reporting fair, consistent, and trustworthy.